Persistent Systems has been a high conviction pick from the Indian IT pack. With a strong end to FY22 marked by superior execution, strong defensive margin and traction in order book, there's little doubt that FY23 would also be a good year, notwithstanding the macro headwinds and increasing fear of reduction in tech budgets. After a dream run, the stock has corrected by over 15% in the past 2 months, underperforming the Nifty as well as the IT index. Despite being positive on the fundamentals, the elevated valuation has made us a tad uncomfortable in the past. Now, with the froth waning, we see the stock weakness as an opportunity to buy into a leader for the long term. With a revenue of $766 million, a growth of 35% in reported currency, Persistent certainly was the growth leader from the IT pack. Interestingly, the organic growth, excluding the impact of acquisition, stood at a strong 32.8%. In fact, in the final quarter of FY22, the company clocked revenue of $217.3 million, thereby marking the fourth consecutive quarter of sequential growth of above 9%. The revenue included $4.7 million from recent acquisition of Shree Partners, SCI and Data Globe, and the organic growth nevertheless was a respectable sequential increase of 6.8%. The growth in service revenue was a strong sequential rise of 14.6%, whereas restructuring of a deal with the top client resulted in a decline in IP-led revenue. With a strong order book and deal pipeline, the company is looking at industry-leading growth in FY23 as well and has so far not felt the impact of macro headwinds. It's looking to reach the revenue of $1 billion in the next 4 to 6 quarters. There was strong growth in BFSI, healthcare and life sciences as well as tech and emerging verticals. In terms of geographies, North America, Europe, India and the rest of the world grew well for the year as well as in Q4. Persistent is among handful players that saw solid margin expansion in the year. EBIT margins expanded by 180 basis points in FY22. In Q4, margins remained resilient at 14% despite headwinds from higher depreciation and amortization, a one-time cost of M&A, supply-side challenges and higher CSR. The company had a currency benefit of 30 basis points. Although in FY23 there would be headwinds in the form of wage hikes, a 70 to 80 bips headwind from acquisitions and high attrition, but the company is confident of defending the 14% EBIT margins, riding on growth, improvement in pricing, higher delivery by improved utilization and better offshoring. The order book remains healthy and the TCV at the end of FY22 stood at $361 million, 46% higher YOY. Close to 54% of these orders were new. Persistent has seen significant bump up in annual contract value as well, which stood at $262 million against $200 million in the year-ago period. While the company's top 5 and top 10 clients have grown, higher growth income has come from outside these accounts, showing a steady success in de-risking the business. Client mining engine is working well, with the company adding decent numbers of large and mid-sized clients in the year, including the last reported quarter. While the demand environment still looks resilient, supply situation, especially for digital talent, still remains tight, notwithstanding the macro slowdown and retrenchment in the startup space. Persistent saw slight moderation in attrition rate on a trailing 12-month basis sequentially from 23.9% to 26.6%, although it remains an area of worry and focus. The scenario could turn a bit better in the second half of FY23. Now, in the last reported quarter, about 700 employees came on board from the acquired entity Data Globe, and 30 to 40% of new hiring was of freshers. This impacted utilization that saw a sequential drop to 80.6% from 83%. The company plans to add close to 3,000 freshers in FY23, and as the delivery pyramid flattens with more hiring of freshers, that could be a powerful lever for margin gains. Persistent is unlikely to pursue aggressive acquisition in the near term and would wait for recent acquisitions to be fully integrated. Like many of its peers, it remains cautiously optimistic and sees strong demand from digital transformation and cloud adoption journey of enterprises, and it hence expects good growth in the next 3-4 years. While we remain watchful of the macros and recession fears impacting IT budgets, we have not seen any overt warnings from the leading players so far. Our growth assumptions are based on a near-normal growth outlook. The execution engine has been very strong for Persistent, and with expected moderation of the talent crunch scenario, we feel decent growth should continue. Valuation premium is waning fast and the market correction provides an opportunity to buy into a strong business. Some key risks to watch order inflow drying up due to the macro concerns and supply side issues impacting revenue.